Let's talk about how to identify bull markets and subsequently avoid black swan events. In the grand scheme of things, this falls into a much bigger picture, and that is that many investors are simply afraid of a market crashing, and because of that, they keep cash on the sideline and out of the market when it could be actually earning returns. Okay, it's not hard to have this fear and emotion of a market crash, in our mind all the time. It wasn't that long ago that we had the great financial crisis of 0809. That's 12 years ago now. It is getting further and further back in our rearview mirror. But then we had movies about it, like The Big Short. And if you turn on the news, it just seems like the news is all doom and gloom. But think about this. Even when the markets are performing their best, during the strongest bull markets like we've had for the last 18 months now, I'm recording this in November 2021. It has been a bull market for a little more than 18 months since the COVID crisis. But even during the best months, the news is always filled with doom and gloom about a crash. Right? Like if you just invested on the news, you would never be in the market and you'd never get any return. So that's a horrible, horrible freaking strategy. But beyond that, let's kind of look at this a little bit more quantitatively here before we actually get into, what I want to talk about. And that is rolling 1-year returns of the S&P 500 are positive 75% of the time, or 74.7. I'm going to round that to 75. But that means that if you were to just invest money in the S&P 500, 75% of the time historically, your market would be positive over the next 1-year period. If we look at that over a 20-year period, it was 100% of the time. So that kind of all goes back to the whole thing. The more exposure you have to stocks for a longer duration of time, the better your return will be, and the more likely you are to have one positive. But even at a short term here of just 1 year, you're still likely to go up, right? So my point here is that markets, broad market indexes in time, like the S&P 500, generally go up. Crashes and black swan events are actually fairly minimal. Now, interestingly enough, there's something called the Investor Sentiment Index. And mind you here, I'm going to go kind of off memory from several years ago when I was researching this. But basically, the Investor Sentiment Index measures the investor sentiment of professional investors like fund managers and institutional managers, etc. Okay, and it measures whether they're feeling bullish or bearish. And whenever that index, the Investor Sentiment Index, scores in the, I believe it was the bottom decile, meaning these the people that are getting surveyed here by, I think it's the Institution of Accredited Investors. I could be entirely wrong, but it's a large professional network of thousands of professional investors. Whenever it's the most bearish in the lowest decile of rating, it actually has outsized positive returns over the next year. And subsequently, you can flip that around, and whenever the Investors Sentiment Index is measuring the most bullish, it actually has the worst returns over the next year. And there have actually been some interesting little timing models that have been done by that. Google Investor Sentiment Index market timing, and I think if you Google that, you'll see the actual returns and kind of some of the research behind it, which shows just how irrelevant investor sentiment is even. I mean, because these are professional these are professional investors that they're measuring on this index. It's their sentiment that they're measuring, and it is just historically wrong. So anyways, let's get to what I wanted to cover here, right? Identifying bull markets and avoiding black swan events. First thing I wanted to point out prior to all that was that, hey, markets generally go up. But let's look at this. What I like to use is simple moving averages. So right here, we've got the S&P 500 represented by Vanguard's mutual fund. So this is the total return of the S&P 500, meaning that it's reflective of dividends being reinvested in the fund from the period 2000 to the end of 2009, 10-year period right here. And our turquoise line is the simple moving average of the last 10 months that we've got going on here. So to get this, I just went to Morningstar, put in VFINX, the mutual fund for S&P 500. And then when here, put in the simple moving average, the frequency is of 10, and that is based on this frequency right here, which is monthly. So make sure you've got this set right to whatever you accurately want to do it. We could set it to daily, and then it would show us our 10-day simple moving average, which that is not, I guess that's not what I want to show you. And I'm not going to select daily right now to show you what it looks like, because then it would reset this timeline. Anyways, we'll come back to talking about days and moving averages in a second here. We can clearly see, when looking at it here, the blue line is above that turquoise moving average line, things are in an uptrend, right? Subsequently, when it's below, when the actual return of the S&P 500 is below its simple moving average, things are going down. So one thing you could do is make a simple little strategy out of this and say, hey, I want to be invested in the S&P 500 whenever the total return, or you could even use price index return, is above its 10-month simple moving average, right? So you'd be in, you'd get out, right? And then down here this month, you would go back into it, but the market would still go down and you'd go out. So it's kind of like a whipsaw because you'd get into the market and it would go down. Same thing down here, right? What if we got in right here and then you basically rode the market all the way up? Well, it does effectively work at minimizing downside risk and volatility events. So let's see here if I got it pulled up. If we were to do this, if we were to go in and out of the market monthly based on whether it's above or below its 10-month simple moving average, let's take a look at what that would look like. And for the period through the 2000s here, you can see it. Okay, so buy and hold had a decline. That's that red line, S&P 500, buy and hold. Blue line represents following that simple moving average. We're in it when the total return is above its 10-month simple moving average. We go out of it and go to cash when it's below. And you can see that blue line just absolutely kills it. All right. So there's our simple moving average. We get out right there. Then we get in right there, but then we get out back down here. We really get in right here and then out down here because it's monthly. It's going to go below it. When this thing crosses that line, we'd get in somewhere around there and we get out right there and then back in. And fundamentally, or not fundamentally, that is exactly what this would do right here. It's trend following, okay? Over a long period of time, you can generally get about market return with minimal volatility and downside. You can see the drawdown of just buying and holding it, 50% right there, whereas here the drawdown was only 6.84%. Now, I mentioned avoiding black swan events. Well, interestingly enough, the simple moving average thing was looked at by Meb Faber. And in this paper, he found that on average, 76% of the worst days in the market and 67% of the best days occur when the market is already declining. And for that decline, he was using a 200-day simple moving average, which the 200-day is about the same as the 10-month simple moving average. All right, so it's 200 trading days equals about 10 months. So they're very similar, but just the same here, we could switch this over to daily. Let's see. Oh, I thought it was going to change, but now our blue line is based on 10-day simple moving average. So let's just change that to 200. All right. So there's our 200-day simple moving average in here, and you can see it looks kind of like the 10-day did, except for the fact that like the 10-month did, except for the fact that it's a little bit more jagged because it's got more points on it, right? And in his research, he found that, hey, the black swan events, the worst days and the best days, occur when the market is simply below the simple moving average, or below, in this case, the 200-day simple moving average. And he did go on to test this across multiple different markets here. You can see this, and I think in most cases, when you miss both those best and worst days of the market, you actually have a higher day than if you just bought and held the market, altogether. So that's really interesting. This is a paper titled "Where the Black Swans Hide." Okay. So yeah, a big thing, if you want to identify the bull markets, look for, whatever you're investing in to be in a market that is in a bull trend or above the 200, or not a 200-day, but above a simple moving average. So let me kind of shore that up, right? Because I've said 200-day, I've said above a simple moving average, I've said 10-month simple moving average. Here's the thing. There's a broad parameter of stability, probably from about a 6-month simple moving average, or subsequently a 100-day simple moving average, all the way up to an 18-month simple moving average. If you're using an intermediate term moving average, if the market is above that, it'll indicate, more often than not 100% of the time, that you're in a bull market. Whereas when you're below it, you're in a bear market. And those trend following rules, or not trend following rules because those aren't specific rules, but those simple moving averages can be used to create rules for trend following, like this one that I show you here, which is S&P 500. If it's above the simple moving average, we're in. If it's below, we go to cash. Okay. Now, before you go on thinking, all right, we found the holy grail of investing here, why wouldn't you want to trend follow when you look at this? Well, this is one period of time when the market was trending very well, like right, downtrend, uptrend, right? So when the market's trending, it does very well. When it's going sideways, it doesn't do so well. And at other points, it'll kind of get whipsawed around. Like if we had a 1987 crash, it doesn't really pick that up because that crash happens so quick. It just kind of drops, right? So let's look at the S&P 500 trend followed, all the way back. So data goes back to 1985 here. Blue line being the trend following, and here suddenly this blue line doesn't really look so good, right? It just kind of looks mediocre. I don't want to say mediocre, but it looks like it's about the same, right? And that's the purpose of trend following, is to perform about the same. So it's within 1% of a buy and hold portfolio. But when you look at this, the drawdown is less than half. So it limits the drawdown. And fundamentally what you're doing when you're doing a trend following strategy is you are avoiding downside and you are trading a few percentage points of return on the upside for protection against the downside. The other thing too that you have to factor into this is taxes. Which taxes would take a haircut on this. I'm not gonna go into tax strategy right now, but do know that when you're trend following or buying and selling and realizing capital gains, you're going to be getting taxed more so than you would if you just bought and held. So keep that in mind. The other thing too is trend following really only works on markets that are trending, I guess. How should I say this? I shouldn't say they're trending, but on instruments, financial instruments that are trending, right? So it works best on broad markets where you've got a lot of holdings in there. On an individual stock, it doesn't necessarily work so well, at least not this simply, right? Because small cap stocks don't really trend and go up and down like this. I mean, some of them do, but most of them are just kind of, like jumping frogs. They go up, they go down, they go up, they go down, and they're really, really hard to see any type of trend with. So on those volatile instruments like that, or crypto is pretty volatile, or levered ETFs, the trend following stuff doesn't really work so well. So I'm going to show you this here on emerging markets, right? This doesn't look horrible, but going back on emerging markets, you can see the blue line being our trend following. It goes up. It protects us a little bit from the downside here, and it cuts the downside by probably, about 50% or so. It doesn't let you go all the way down, or doesn't let you have the same drawdown as the entire market, but you still have some drawdown. But what you can look at is, unlike on the S&P 500 where things kind of, go up pretty steadily and smoothly here, you can see it gets whipsawed around. Over a longer period of time, it's still, over this period of time, outperforming emerging markets, which have basically done nothing for the last 10 years except zigzag around, right? So keep that in mind. So how can you tie this back into your investing? Well, you could use simple moving averages, and come up with some rules. And mind you, I'm not going in depth on the trading rules of simple moving averages. I do use them actively for my own portfolio and such, but I'm not going in depth on it. You kind of need to do your own research and kind of figure out some rules. Just know that these are options to look at. But, you could say, all right, I'm going to have market exposure only when the underlying market is above its simple moving average. So let's just say that you are trading small cap stocks, right? Well, if you're trading small cap stocks, you'd want to look at, I don't know if it's going to pull it up, but we would want to look at you might want to look at the small cap index and say, okay, hey, this month, is the small cap index above its 10-month simple moving average, or is it above its 200-day simple moving average? If it is, then yes, I'm going to trade this strategy. If not, the market's kind of, I don't want to say it's kind of in a bear market. It might be entering a bear market, or it might be in a bear market. So I'm not going to participate in the market. I'm not going to trade. I'm just going to hold cash, or I'm just going to hold a lower risk asset, right? So only, exercising your trading strategy when the market is above its, intermediate term, only executing your trading strategy when the market is above its intermediate term simple moving average is how I would use this, so that, I'm getting the most exposure when we're in the bull markets, and subsequently avoiding those black swan type of events and the downside.